Hey there everyone, welcome back to my channel. I'm Maggie, your best real estate partner in Seattle. In today's video, we're going to talk about some big news that could shake things up in the housing market. So in the past 2 weeks, the 30-year mortgage rates in the US surprisingly dropped to 6.35%, the lowest we've seen since May 2024. Do you think that sounds like a good thing for buyers? Well, we'll have to analyze the recent not-so-great employment report that predicts why the Federal Reserve might start officially cutting rates as soon as September. But here is the real question. Will these rate cuts actually revive the housing market and push home prices up again? Today, we're looking into some recent data to break down the impact of the rate cut on different real estate markets in the US. And hey, I'll also share my own thoughts on what the next few years might look like for the market. Alright, let's first talk about what traditionally happens when mortgage rates drop. Generally speaking, a drop in mortgage rate is good news for the real estate market. After all, most of us need a loan to buy a home. So when borrowing costs decrease, our monthly payments go down as well. Why is this not attracting more buyers though? Factually speaking, since August, the mortgage rate in the US has dropped from 7.22% in May to below 6.5% now. So if you're wanting to buy a $500,000 home, you could save about $200 a month on interest payments. Sounds like a pretty good deal, right? Because this is the lowest rate we've seen in the past year. But here's where things get interesting. Despite such low rates, the market hasn't exactly been responding as you might expect. The response in reality is quite surprising. According to Redfin's article from August 1st, the number of pending home sales across the US has dropped by 5.7% year over year, marking the largest decline in 9 months. As if that wasn't enough, a report released on August 15th noted that home sales nationwide decreased by 5.1% over the past 4 weeks. What's more shocking is that the number of new listings only increased by 4.5% year over year, the smallest increase in 3 months. This situation shows us that even though rates have gone down and theoretically affordability has improved, many buyers and even sellers are still holding back. We haven't seen a clear market rebound just yet. So the question that pops into our head is, why aren't these low rates having the impact we'd expect? Here's what I think. Firstly, over the past few years, home prices in the US have been too high for so many people. For example, from March 2020 to June 2024, Miami's home prices shot up by 63.6%. Though it's just not Miami, places like San Diego, Austin, and Seattle witnessed prices jump over 50% also. More considerable factors, such as the national median home price hitting a record $442,000 this May, give us a clear picture of the market regardless of the slight drop since. These sky-high prices are way out of reach for most people residing in the US. There's a thing in economics called price stickiness. What price stickiness really means is that even when fewer homes are selling and there are more on the market, prices don't just drop as you might expect. But the question is, why not? Well, think about it from the seller's perspective. They have their home listed at a higher price, hoping or maybe even convinced that once the market bounces back, they might get the price they're asking for. So the seller holds out and waits, sometimes for a really long time, without lowering the price for the home. Because of this, many homes just sit there on the market without any price cuts for a really long time. So here we are, stuck with high prices and high mortgage rates, making it tougher than ever to buy a home. Probably the least affordable it's been in the past 20 years. Now, let's talk about the time of the year and how it impacts the market. Since it's already August, we've missed the prime home buying season. You see, most families who want to move into a new home before the school year kicks off usually try to buy in the spring or early summer. Sellers know that, so they like to list their homes earlier in the year as well, which makes more sense. Besides these factors, another issue to consider is mismatched supply and demand. If buyers can't find what they're looking for, the available homes on the market don't really make a difference to them. Take the east side of Seattle, for example, places like Bellevue, Redmond, and Kirkland. Tons of buyers are on the hunt for those perfect entry-level 3 to 4 bedroom single-family homes, especially in a good school district. And guess what? Those homes are in such a high demand that when one does pop up, it can get over 10 offers. But let me tell you the flip side though. All those lower-priced condos, townhouses in Seattle, they've been on the market for almost a month with barely any interest. So even when most people aren't able to afford a pricier single-family home, the big demand for them keeps the supply and demand all mismatched. So let me state a wild stat for you. According to Redfin, as for August 11th, 2024, nearly 2/3 of the homes have been on the market for over 30 days without selling. That means a lot of homes are sitting on the market waiting for the right buyer. And the last factor on our list is the clear economic and political uncertainty. Early this month, on August 5th, the global stock markets had a massive setback. I'm talking about the Dow Jones dropping over 1,000 points and the Nasdaq falling 3.4%. This economic setback didn't only affect the market, but was a clear awakening call for so many buyers as it reminded them of the current instability. The upcoming presidential elections, ongoing conflicts like the Russia-Ukraine war, and Middle East tensions also make the buyers wait until 2025 as they want a clearer situation before they consider buying. These four factors make the real estate market relatively inactive. A rate cut of 0.5 to 1% has a very limited impact on the current market, much like chicken ribs. Not very useful. I believe that unless these factors change significantly, the market will remain sluggish this year. As promised, at the end, I'm going to share my thoughts on what the future holds for the market. So I consider the predictions from Fannie Mae and Freddie Mac, according to which the overall home prices growth in the US will go down over the next year or two. We can expect to see a slight decline in prices in some areas. The basis for this trend is the reduced demand and rising interest rates. For example, home prices rose nearly 60% in some parts of Texas and Florida during the pandemic, but once the rates went up in 2022, the prices dipped. With more homes now available, Zillow also predicts prices will drop another 0.9% by next year, making home a bit more affordable, hopefully. So let's get into interest rates. According to Fannie Mae and other institutions, mortgage rates can likely stay at 6.5% in 2025, or even drop to 6.2% by the end of 2025. Rate cuts are undeniably a slow process. While they will improve affordability to some extent, I think it will take rates dropping below 6% or even to around 5.5% before transactions return to pre-pandemic levels. And now let's discuss economic stability. The US could indeed face some tough times ahead, according to many economists. The latest Global Economic Outlook report by the IMF states that the US economic growth could slow down to about 1.5% in 2024. Such economic weakness could result in lower home prices, but it would make the buyers hesitate. These sluggish market conditions could last until 2025, according to Fannie Mae. So, to sum it all up, I think the real estate market will keep adjusting slowly over the next year or two because of those high interest rates and high prices. Take Seattle, for example. We are seeing a gradual shift, with some homes like condos, townhomes, and luxury properties starting to lower their prices after sitting on the market for a while. As factors like falling home prices, lower interest rates, stable economic conditions, and more home supply coming into play, we might see the market return to normal. It's best to be prepared as this could take another 2 to 3 years or even longer. So if you're thinking about buying a home, especially for investment purpose, don't expect quick gains. Instead, I suggest that you focus on long-term factors like population growth, potential income rises, and the cost of buying, selling, and holding the property. And hey, consider renovating or developing properties to boost your returns. I'm looking into some opportunities myself, and I'll definitely share if I find any good ones. That's it for today's video. If you enjoyed the content, please hit the subscribe button. Thanks so much for watching and see you next time.